The PCE index hits 4.1%, the hottest inflation reading since spring 2023. That number decides if rates go up or down tomorrow, Thursday, June 25, 2026. Like and subscribe for daily market updates. Today's agenda: the PCE Bomb, market snapshot, oil peace deal, metals bleed out, crypto struggles on, chip earnings beat. So how did the market react before this news dropped? At 8:30 Eastern this morning, the government releases the Personal Consumption Expenditures Price Index. Economists expect it climbed to around 4.1% over the past year. That is the hottest reading since spring 2023. In a normal year, an inflation print like that simply means no rate cuts for now. But here's why your stomach should tighten. Under this new Fed chair, Kevin Warsh, who has been combative about fighting prices higher, it could mean something almost nobody was forecasting 6 months ago: a rate hike. The core reading strips out volatile food and energy to expose the underlying trend. That is expected around 3.3%. We already got a preview 2 weeks ago, when inflation data jumped to 4.2 in May. A PCE following higher would surprise no one, handing Warsh ammunition he has signaled he wants. The Fed's own dot plot flipped from penciling in a cut to penciling in a hike last week. Markets saw less than a 1 in 3 chance of an increase by September. This morning, that jumped to roughly 2 in 3. I think the market is underestimating how fast Warsh can move if he sees these numbers stick around for months. Heavyweight banks now openly forecast multiple increases before year-end. That changes everything about where stocks are priced right now. Up next, oil peace deal. Let's set the board right now. Wall Street closed Wednesday split down the middle, and that is still influencing mood today. The S&P 500 dipped a hair to just under 7,360 points. Tech-heavy Nasdaq slipped about 0.4% overnight before futures erupted later. But here's what matters. The Dow pushed higher up around 180 points, and small-cap Russell 2000 eked out gains too. That mix close is already ancient history, because after the bell, memory chip giant Micron blew doors off earnings, sending Nasdaq 100 futures pointing up nearly 2% as we speak. Overnight in Asia, it was a stampede. South Korea's Kospi jumped 6%, Japan rallied hard. The mood has flipped from anxious to risk-seeking, money charging back into higher growth corners. Even the small-cap Russell is firming up. The fear gauge VIX eased to around 19 points. The tension you need to hold in your head: a roaring AI trade colliding with a Fed that may be about to get tougher. Gold broke below $4,000 an ounce for first time since November, and Bitcoin slipped another couple of percent. With oil down, let's see how gold is reacting to all this chaos. The reason oil is crashing is the single biggest global political turn of the season. The Iran war is fading. After months of conflict that began with US and Israeli strikes back in February, Washington and Tehran have moved to a ceasefire framework signed in Switzerland. Crucially, tankers are once again moving freely through Strait of Hormuz, narrow choke point carrying roughly 1/5 world's seaborne oil. The US has even cleared Iranian crude sales through August, and President Trump says Tehran assured him there will be no tolls or extra charges on commercial ships. For markets, this lands with double force. Energy prices are tumbling back toward where they sat before war started, draining inflation risk premium that had everyone on edge all spring. And the drop is about more than peace alone. Gulf barrels are preparing to flood back just as war crushed demand previously. Crude is close to erasing every dollar of wartime gains. The path from here rests on one fragile word: durability. A single flare-up near Hormuz would send crude, and safe place to store wealth assets screaming back other way within hours. I think this quiet de-escalation is engine humming under everything else right now, but investors must remember that peace deals often break quietly. That brings us to crypto struggles on. To commodities themselves, crude oil sits around $70 a barrel and Brent near 74, both at lowest, since before war erupted. Gold remarkably has become victim rather than refuge. It broke below $4,000 an ounce for first time since November, 8-month low. Silver hammered even harder, down near $57, 7-month low. Why are metals bleeding amid all this uncertainty? Two forces working together right now. The dollar is on a tier, index just punched highest level in over a year, and strong dollar makes dollar-priced metals costlier around world. Add prospect of higher rates from Fed Chair Warsh leaning toward tighter money, and gold, which pays you no interest, simply hurts to hold still more. Still, not everyone reads slide as top. Camp Macro Strategists argues this is correction inside longer structural bull. They point central banks swapping US debt for gold as neutral reserve, silver facing 6th straight year, supply falling short demand. A falling price into raising interest rates physical market is unusual split. I think the dollar strength alone explains most of these drops. Once Fed stops raising rates or cuts later this year, metals will bounce back fast. But the real story today is Micron earnings, which changed everything for chip stocks overnight. Now, Crypto Pulse. Bitcoin refused to join the rally as stock futures surged on Micron earnings overnight. The digital asset slipped another couple percent to around $61,000, pinned by a strong dollar in favor of higher rates, Fed undertow suppressing global risk appetite. It trades just under key long-term support near $62,500, historically significant for preserving equity during available cash in the market crunches. Ethereum lags in the mid-$16,000s, mirroring tech sector vulnerability, while rates remain elevated. Flows reveal who is selling. Spot Bitcoin ETFs have bled cash for 6 straight weeks, with only a small inflow this week breaking the streak. This outflow reflects institutional reducing risk as capital seeks yield in safer havens rather than volatile crypto assets. The crypto fear gauge sits at extreme levels, signaling retail investor mood has bottomed or is merely reacting to macro uncertainty. For brave hands, these are accumulation zones where smart money builds positions before the next leg up. For exhausted traders, they look like panic selling depending on how long high rates persist beyond Wall Street expectations. I believe Bitcoin needs a rate cut cycle to explode again, unless AI stocks push hard enough to ignore macro challenges completely. Investors must recognize that, without monetary easing, capital costs remain too heavy for speculative assets to thrive independently. The second-order effect is potential rotation into defensive sectors if earnings growth fails to offset inflation fears. Historical comparisons show similar patterns in 2018 and early 2020, where crypto struggled until available cash in the market improved significantly. Concrete implications suggest holding cash or high-yield bonds may outperform digital assets until the Fed pivots toward dovishness, validating a wait-and-see strategy for most portfolios, while contrarians watch support levels closely for any sign of stabilization before entering long positions. Finally, let's wrap up with what matters most for your portfolio today and tomorrow, specifically speaking clearly enough for everyone to understand. Name owning every screen this morning is Micron Technology Inc., a move signaling the definitive shift in semiconductor economics driven by artificial intelligence demand. The numbers are staggering. Revenue rose $41.5 billion, more than tripling from last year. Profit reached $25.11 per share against expectations near $20. This massive outperformance was not luck, but the result of aggressive capacity allocation to high-margin AI memory modules, effectively pricing out competitors who cannot match their yield rates on specialized stacked chips. Gross margins nearly 85% set an all-time company record. Management guided next quarter around $50 billion in sales and pointed to $100 billion in customer agreements already locked in globally across data centers worldwide. These figures represent a structural change, where supply constraints have finally aligned with insatiable cloud computing hunger, allowing Micron to dictate terms rather than beg for volume. High-bandwidth memory specialized stacked chips feed AI accelerators, where Micron effectively sold out completely today, before the market opened here in America this morning, after hours trading ended yesterday evening Pacific time. This event clearly changed industry dynamics, significantly moving forward starting immediately upon release of these results globally across multiple markets simultaneously, including Asia, Europe, Latin America, Africa, and the Middle East regions affected directly or indirectly. This mirrors the 1980s memory boom, yet this cycle differs because AI requires persistent data retention at speeds previously impossible, creating a new moat that legacy players struggle to cross. Investors must now recalibrate how expensive assets look relative to earnings based on pure revenue growth rather than traditional volume metrics. Companies holding these contracts will likely see sustained outperformance, while those lacking similar technology face margin compression in an increasingly bifurcated market landscape defined by who controls the memory bandwidth for next-generation models. The market faces a split mood today, balancing chip-led AI euphoria against the risk that higher rates are here to stay. The PCE inflation index hit 4.1%, its hottest reading since spring 2023, which effectively locks in elevated interest rates unless Fed Chair Warsh signals a dovish shift soon. While Wall Street analysts previously feared slowing growth, Micron's earnings beat proves AI demand is accelerating significantly across global markets. Additionally, an oil peace deal has drained the inflation risk premium, supporting stocks even if the Federal Reserve maintains hawkish rate policies longer than expected. Thanks for watching Market Pulse Daily.